much, and today we're going to talk about Walgreens. Yes, Walgreens, the company that I've talked a lot about on this channel. And I don't know, it's also a stock that I'm not really excited about anymore, but the reason I'm talking about it, originally I mentioned it was probably a buy, and then after that I had kind of revised my thoughts saying, this is not how I normally pick stocks. Usually I wait for some kind of big news cycle or closer, to earnings or something like that to really evaluate whether it's a good buy or not. So because of that, I was picking the stocks a little bit early, that Walgreens and the few after that. So now they just came out with earnings, and so now I think it's kind of a time that I would traditionally look at the stock closely and see whether it is a buy or a sell for me. So yeah, so I'm going to talk about that, whether it is still a buy or whether things have changed, and kind of discuss where this company might be going. So Walgreens Boots Alliance is under the ticker symbol WBA. It is, for those of you who don't know, a pharmacy slash convenience store, and it basically has stores throughout the United States. It also has stores and partnerships around the world, so they're in the UK and China, among others. So yeah, but it's mainly in the United States. Now, they just came out with their earnings. The forecasted earnings that they had were $1.65 to $1.75 for the range. And they came in at $1.24, which is horrible. Now, because of this, and also because they had a revision in their guidance also was down. They kind of said they're going to have flat growth for the next little while. This really hurt their stock, and their stock was down yesterday like about 12%. Really, really bad. It's currently sitting at $55.48 after hours. That gives it a PE ratio of 10, which is pretty cheap still. A forward PE ratio, the lowest estimate is 9.2, and if you were to revise that kind of the way their actual earnings were, you might get higher to like a 12.3 or maybe even higher than that. And a forward PE ratio of 16 is probably normal for most companies. So 12, it's still reasonably cheap. But, it might be higher than that. So something to be aware of. But I do see this stock is probably still cheap. And that's kind of why I'm still thinking about this as a potential buy, but there is more that came out in the earnings. So the price to book ratio 2.0, not cheap, kind of just whatever, I guess. It's not great, but it's not horrible. The dividend, because the stock has dropped so much, it's now at 3.2%. So if you wanted this as a dividend stock, a growing dividend, it might be a decent time. The 5-year intrinsic value growth rate has been 16.3%. So this company, it's one of its shining things about it is it has been growing really well. Now that might drop off quickly, especially with their guidance saying that they're going to have kind of flat earnings growth. So yeah, those are kind of the breakdown of the company. They had poor earnings reporting, really poor earnings. They didn't give any forward notice of this, so people are a little bit shocked. That said, maybe if you had looked at CVS, you might have been able to predict, oh yeah, they had a little bit worse earnings than expected. Maybe Walgreens will too. But most people got kind of taken by surprise. The downward guidance, not good. Also, they said the headwinds for the company are continuing, so things like Amazon or Walmart kind of taking their, competitive space away. It's happening faster than expected, and they're not being able to transition to their enough online presence that they want as fast as they're expecting. So those are big headwinds for the company. And they also had some currency issues because of they deal with multiple countries. So those are problems for the company, and it kind of makes me think there's two scenarios for this. There's a positive and a negative scenario as usual, but they're potentially drastically different. So the positive scenario is this stock drop is a little bit unjustified. So yes, they did. I mean, it's justified in the sense that they didn't meet their earnings, but it could be a blip in the radar. Like they might just they might have hit a low earnings now, but later on their trajectory might change. It might be just, there could be lots of factors that went into a bad quarter. And their competitive threats like Amazon might not be as big as anticipated. The Amazon effect in other industries has been overstated, so I wouldn't be surprised if it was here. So you could see this as, a little dip, and in the future the earnings might do just fine. And so this company, even though they've guided to a much weaker, like a flat growth, they could easily exceed that in the next quarter, and so things could be totally different. And even if you look at, their forecasted earnings for 2021 even were around $7+ per share. Even if it was worse, even if it was like half of that, and you had $3.50 a share, I still see this company as probably undervalued. It could even be valued around the $60 mark, even in that case. So pretty crazy to think it's that cheap. So I see the positive cases. It really could, be double its price in a couple of years. Now the negative side, and this is something that kind of came out in the quarterly report that wasn't mentioned before, and that was, it kind of involves the whole equity and assets and goodwill that they have. So basically, if their earnings do go down, say the Brexit really affects their business in the UK, say the economy does slow down, say they can't compete with the competitive threats like Amazon or Walmart, and so they just keep losing, not losing money, but their earnings just don't grow at all or just stay flat or go down. Then this problem I see is that they could have a reduced cash flow. And if they have a reduced cash flow, like in the past they had $6 billion of free cash flow and maybe $20 billion in liabilities, current liabilities. So they can kind of pay that off. It's reasonable over time, over a reasonable amount of time, a couple of years, 4 or 5 years, something like that. But if you go to a scenario where they're only making $1 billion free cash flow, or even less than that, then you're looking at 20+ years to pay off their debts. And then they might get, different credit ratings. Things might slow down for the company in that sense. People might not trust them as much to pay their debts. And you might think, well, maybe they can sell, some of their business to kind of pay for that. And if they had more assets than liabilities, which it appears they do, that could be the case. But the problem is, and they mentioned it in their goodwill, is that their goodwill might not be as safe as is expected. So they mentioned that they would probably mark down only to their carrying value of the companies. So something like the Boots Alliance, they might mark down 11%. But they also said other reporting businesses were maybe more than 3 times their carrying value. And in that case, they could be marking down quite a bit. They don't really give too many details. And just when a company, they don't really mention that they're going to have a really bad earnings report, or they don't mention exactly what's going on with their goodwill, that kind of gives me a warning sign that they could potentially just, cut all their goodwill. You could think of a bad case scenario. So if they cut all their goodwill, then they have more debt than they do assets, and in which case, if they don't have enough free cash flow to service their, current debts, their overall debts, even if they sell parts of the business, they might not get to, it might save them for a little while, but if they can't grow their earnings because of competitive threats, they could be in a situation where they just can't service their debt, and they could go in a real tailspin, and somebody might have to buy them out, or they could go bankrupt. So this is a really serious threat for the business, and for that reason, I would say it's probably very cheap, and so probably a good buy. But because of this risk that just came out in this quarter, I see this as probably a company I wouldn't want to touch. So it's probably a hold, because I said it was a buy before, maybe I'll say a hold, but honestly, it's probably a sell at this point. So that's my biggest worry. I'd love to know what you guys think. Do you think Walgreens is safe? Do you think it's, everything's overblown and you could see your money double over the next couple of years with this stock, plus have a reasonable dividend? Or not? Let me know in the comments.